What an absolute whirlwind of events. It was only Thursday night I was making a video about Silicon Valley Bank, warning about grim prospects ahead for the shareholders, unlikely to see a potential recovery. Then, of course, it was seized, stock goes to zero. And then today, Sunday night, just fast forward a few days, you see a joint statement by various different branches of the U.S. government, seeing the FDIC, the Federal Reserve, the consulting with the president, President Joe Biden, you have Treasury Secretary Yellen approving actions enabling the FDIC to complete its resolution. Okay, so what's that mean? That means they're fully protecting all the depositors at Silicon Valley Bank. And they also are taking over Signature Bank as well. So now it's two banks for the price of one this weekend. Well, what's this mean? Is this actually a big deal? Well, is this crisis averted? This is your first time tuning in. My name is Daniel. You're watching Unrivaled Investing. So what this means is that the U.S. government, through the FDIC, said, look, we recognize if you have a $100 to $200 billion institution, that might be the new too big to fail. And so instead of letting them fail like they have effectively this manual to do so and having disruptors, having depositors disrupted, they're saying, we don't want to have that impact on the economy, because what we've seen clearly is that if you have a $100, $200 billion bank, and Signature was a $100 billion bank and Silicon Valley Bank was $200 billion bank, the repercussions of all the companies that have their payrolls that are tied to the deposits that they have with these companies, we don't want to see the economy just hemorrhage and all of a sudden have a shock because that these two large banks, all of a sudden, are seeing capital being pulled out because a lot of folks realize that they're insolvent. And that's what you're seeing right now is the U.S. government stepping in saying, we will make sure depositors are made whole. And that's a big deal because the insurance only covers up to $250,000. And a lot of folks putting in millions of dollars for their payrolls. Now they're saying, okay, you can breathe easy again, because not only will you get back all your money, but you'll also get it back in a timely way starting Monday, March 13th. So the next day. So in this covers, I'd argue 90% plus of the crisis that folks faced, over the weekend of folks talking about a potential, banking crisis. And they also talk about how these losses won't be borne by the taxpayer, that this actually could be even profitable for the U.S. government or taxpayer. And some people might be critical, like that doesn't check out. Actually, for me, it does. If you look at the history of like the TARP warrants and the previous great financial crisis financing, usually the U.S. government made money on this. In this type of situation, what ended up happening is these banks were technically insolvent because interest rates had moved higher, not necessarily because they had made a bunch of crappy loans. Because interest rate moved higher, the value of those bonds dropped. 1%, a bond offering 1% is worth less in an environment where interest rates are now 5%. It's not worthless, but just the value of it just dropped, worth less. And the U.S. government can say, we don't have a bank run on us. And so we can just take over this portfolio of assets, and we're just going to hold it into maturity. We're going to hold it until the bonds repay. And the bonds are oftentimes very secure, very stable bonds in the sense that, it's oftentimes even U.S. Treasuries that sold off 20 to 30% last year because of higher interest rates. So, it's an example where the taxpayer, doesn't really have a huge cost. And look, this is not only Silicon Valley Bank, but also Signature Bank, $100 billion bank, talking about, look, the same formula applies. All depositors of this institution will be made whole. Once again, no losses will be borne by the taxpayer. However, shareholders and, unsecured debt holders, they will not be protected, and you're kicking senior management out. This all makes sense. This seems like a very rational and measured response by the U.S. government saying, look, if you have equity in an institution that made some bad bets and the U.S. government had to intervene, you get wiped out, and good chance the bondholders get wiped out as well. That might mean, we'll see how this plays out, but that might mean, the short-term reaction is like crisis averted, stock market up a couple percent tomorrow. And I suspect you see something like that. But if I were a bondholder in an institution that was questionably solvent, I think you could see a movement in the credit markets where folks are going to say, well, wait a second, do I actually want to have this risk exposure to institutions that might be zombie or insolvent? Zombie meaning they're technically insolvent, but they just stay alive because you have measures like this where the government prevents them from going out of business or enables them. And that's actually this direct next measure by the Federal Reserve, kind of enabling zombie banks, because they said they just announced will make available additional funding to eligible. So this was a whole separate announcement by the Federal Reserve. So they're saying, hey, we'll make additional funding available to various different banks to help them meet whatever needs they have from their depositors. So if they're facing a bank run, they will help them out. How are they going to help them out? And say, they put this in clear English to make sure you understand they will not tolerate a great financial crisis. They've learned their lessons. The Federal Reserve is prepared to address any liquidity pressures that may arise. That is very strong code for, look, we will print money if we have to. So all that raising interest rates to deal with inflation, yeah, that book, you throw it out the window, and now you're focused on like making sure the system doesn't catch fire. You're going from hot inflation to on the brink, and what are you going to do about it? And now they're saying, okay, get the fire hose ready, and that's what you're looking at here. Like, we will do whatever it takes. That's the sort of the commitment you're seeing here. So what's this program from the Federal Reserve? Well, they're offering loans for up to 1 year to banks for let's say the U.S. Treasuries, the mortgage-backed securities, the agency debts that have sold off significantly in value, but they're going to mark these assets valued at par. So they're, once again, you have a 1% Treasury. Now Treasuries are 5% or 4%. Those Treasuries are worthless, or those U.S. bonds are worth less because interest rates are higher. But the Federal Reserve will accept them at par. They'll give you 100 cents on the dollar if you want to have a loan against it. So they're willing to sort of help you out because they do not want you to be quickly selling those securities in times of stress. They don't want you being a forced seller if depositors are pulling. So this does enable effectively the new era of zombie banks. And that is a little bit concerning. That doesn't help capitalism thrive, I would think. But at the same time, it also prevents, conflagrations in the system where everything catches fire and you have just a sudden shock to the system where unemployment just lurches higher. It goes from 3.6% to 7% in a couple of months. This is a big measure by the Federal Reserve. It's unclear exactly the dollar commitment. You see the U.S. Treasury saying, hey, we'll back you up an additional $25 billion if you need, but Federal Reserve saying, hey, we're not going to need it. Fundamentally, however, this really doesn't solve the problem. The problem is, to the tune of several $100 billion at least. I suspect it's actually close to several $1 trillion. So what's that chart showing? Well, once again, if you have a period where interest rates are very low, and you have all these, capital allocators, whether or not someone running a bank, a pension fund, what have you, buying bonds at very low interest rates, and then interest rates move higher and those bonds, those long dated bonds, those 10, 20, 30-year bonds drop in value, you still have a huge hole. And that's what this chart is showing, which is that per the FDIC, this is not some third-party estimate. I mean, this is the government saying, hey, the securities that either held to maturity or available for sale securities are to the tune of, like $700 billion. If you spread this to loan portfolios, you're probably talking about the trillions in terms of this huge loss in the banking sector that's going to need to get sort of papered over in time. And that's the challenge that you saw with these banks is that, well, if the loss is so big and you now appear to be insolvent, if enough depositors start pulling their capital, now these banks are really in trouble. That's why the Federal Reserve just set up this new program. So that way, hey, you can take these securities, these bonds that you now have this $600-700 billion loss and say, hey, we can actually pretend that these are really worth 100 cents on the dollar. It is problematic in my opinion. Okay, so who wins, who loses, in this sort of situation? First of all, in full disclosure, this is not financial advice. So, as I think about who wins, who loses, first of all, the depositors clearly win. The depositors at these insolvent banks, they win. It's very clear, $100-200 billion. Now the U.S. government is treating that as too big to fail. So the small businesses, the mid-size, the large businesses, any business that had amounts well over that $250,000 limit, you can sleep much better knowing that the U.S. government is saying, hey, we will make sure you're covered, you're set. Shareholders of the banks, the bondholders of the banks, they lose clearly in this situation. But they deserved it because the banks were made some very poor capital allocation choices, which was, to not hedge that risk that interest rates could move up and their bond portfolios could drop significantly. So that's an important data point. I think another person who loses, or another smaller subsect of the, the capital allocation pool is that patient investors and disciplined investors lose. I think the Warren Buffetts of the world lose out in this situation because, they've made a point of not reaching. They've made a point of sitting on their cash, collecting lower yields because they said, hey, I'm not going to take that risk. And there have been several prudent investors that didn't, reach. And so I think in a sense, the moral hazard is sort of real, those, and we'll talk about that in a second. But I think you also aren't getting the opportunities that a patient investor would have gotten. I have sizable cash allocation and I'm sort of thinking like, does this mean it's a lower probability that you see a stock market crash? Absolutely. I think it's much lower probability. I still think things aren't, crazy compelling, but I still think, it's a much lower probability if you have the Federal Reserve trying to say like, hey, we'll make sure there's no fire in the banking sector. We'll do what it takes effectively, even if we see this very clear problem that we partly, created by raising interest rates. Now they were doing it to offset, inflation. I think the taxpayer in this case wins short term. And that might seem surprising to you, but the reality is if the U.S. government were to just be like, hands off, let's just see what happens. This is kind of like a bailout, let's see what happens without providing this backstop. That's probably a better frame, this backstop for these banks. If you let that happen, then you'd probably get this daisy chain, multiple banks fail. You would have the shock to the economy. And then the government would have to probably overshoot with huge deficit spending to just sort of help, unemployment and help that. So I kind of think actually the taxpayer wins out in this environment. Because with this backstop, they're probably not going to have to pay anything because you're seizing this bank, you get the assets, and you don't have to sell the assets right now and realize that loss. You just collect the interest. It might not be the 5%, in theory you could get right now, but it's at 1% previously. So you're collecting that. And in time, you're going to easily be made whole, probably make some money off of it, I would suspect, but it's over time. But that fundamental problem of, you have deposits that are very short-term in nature and you have investments that are long-term in nature, that duration mismatch, that loss still very much exists in the system to the tune, I would suspect, of trillions of dollars, creating the risk of zombie banks. And that does create my concern of moral hazard. And you might say, Daniel, this is not the time to bring it up, but especially when, you have the prospect of, tens of thousands of businesses struggling to meet payroll because, a bank isn't able to make sure their depositors have access to their capital. But I think it is worth understanding, like, there are going to be some weird secondary effects to this. For example, let's say 3% of CEOs are psychopaths and, that means they're going to do whatever it takes to get bigger and grow faster. And, I'm saying ballpark figure, maybe it's 1%, maybe it's 5%. So what prevents them in this scenario to say, hey, let's just grow like crazy, where my incentive compensation is tied to how big we are. And let's offer depositors, like 5%, 6%. Let's do whatever it takes to grow like crazy. And, if we make some good bets, then great. We'll win a lot of money. And if we don't, then okay, I'll get fired, but I'll probably made a lot of money on the way up. I don't see the problem with this is I'm not seeing the teeth in sort of the clawbacks that like management is getting all their bonuses and the stock that they sold at, lofty valuations. I'm not seeing any clawbacks. And that's what makes me concerned here is we're not addressing part of that fundamental agency problem, which is that management can make this risk because now they're going to feel enabled. This let's say 3 to 5% of the population will feel enabled to just say, hey, this is great. Now I can go, really, push it to see what can happen. Now I can go, I'm just going to buy 30-year bonds. And if the yields are going to be great, I'm going to really juice things. So it is a concern. And it's also a concern like, hey, do you potentially have inflation last longer? A whole separate other conversation, because now the Federal Reserve will be less likely, now the market previously, just last week, the market upped its likelihood that Jerome Powell was going to have to raise by 0.5% from 0.25%, because he effectively was telling Congress, like, inflation's just too hot, folks. Does this mean they walk it back? Do they do zero and then you get real animal spirits going? And so does that mean inflation isn't really conquered yet? So you have all these different elements that go into this. Honestly, I look at this and it doesn't make me feel great. Like, it doesn't make me feel like, oh, like I got to buy right now. Like, just because things start rallying a bit on this sort of stimulus, I don't think the fun, on this backstop doesn't make me feel great about it. I mean, there's still this fundamental problem in the banking sector, with like a $1 trillion plus hole in various balance sheets because interest rates moved higher. You still don't even have any impact yet from a potential recession. And by the way, it's not like valuations are cheap. You're still talking about very high teens earnings multiple for something like the S&P 500. So I still, in this environment, cash is still doing better in most cases than a lot of different equities, just because you're getting, that stable 4% plus. That's where I personally keep my cash at Interactive Brokers, link below. And so, it's not super compelling when over a week, it's like, oh my goodness, look how fragile things are. This is not, and it's, if you have something that's fragile, at least be compensated with lower valuations. You're not even getting crazy cheap valuations. So I'm very mixed on this. That's how I'm personally feeling about it. I mean, like, maybe you see the market rally because of this, huzzah, but is that really driven by strong fundamentals? No. And has this fundamentally solved inflation? No, which is another key problem. Has this fundamentally solved the fact that you had all these bankers making bets that they shouldn't have made on long dated bonds that are now blowing up in their faces? No, this hasn't solved that. So that's the part that I don't like about it. But, clearly it's better to have some, I suspect it's better to have some sort of backstop than having a conflagration in the banking sector. And that works until people don't want to own like US treasuries, until the problem goes from the corporate level to the sovereign level. And when that happens, then it's game over. Then you can't do stuff like unlimited backstop for banks. And so that's the, like, hey, we haven't hit that point yet. There are some countries, I suspect Japan is very, very close to that situation, where you're like, hey, like, we could just print endless money, and the bank, the bondholders are like, you can't do that. And the same thing happened with Britain, a few months ago. So we're not there yet, but I'd suspect that's the next, evolution in terms of how this crisis management works, is that eventually you go from corporate level defaults to, hey, people don't want to buy your government bonds and you can no longer run these excessive deficits. And now what are you going to do? And that's going to be the painful choice in the years ahead that I suspect we see this decade, how that sort of plays out. If this video has been helpful for you, please make a point of hitting that subscribe button. You've been watching Unrivaled Investing.